I wonder, when you look at the Bank of England, they're trying to say all these things that seem contradictory, even in their statement today. They're doing this because, and it will be carried out on whatever scale is necessary. However, they're saying they're going to limit the time frame so that they're just doing it between now and October 14th. They're going to be spending more to be buying these gilts, but they also say they're still planning on this $838 billion pullback on their balance sheet at the same time. Which side of the ledger do we believe on this?
Well, they're trying to thread something that's really, really difficult given what's happening on the fiscal side. So they're trying to stabilize markets. They're saying we're going to do what we need to in the near term. And then when we get that set, we're going to go back to where we were. It's quite hard to do that with the fiscal side of the equation, where it is over there.
And can it be counterproductive where people see initially the markets rallied and, oh, look, they're doing something. And then you realize this is a drop in the ocean, probably not going to work. And it just shows, almost seems to indicate a bit of panic in terms of their ability to stay in a tightening mode over at the UK.
I mean, the central bank, they're here is the entity that everybody looks to when things really start to feel uneasy, and you certainly have that in the UK now. So they feel compelled to try to step in and stabilize and have markets settle down. But they're trying to thread something, given that fiscal is out of step, and really was quite. And Becky was saying this. What happened over there was it's consistent with some of the things here, but out of scale, and it was shocking and quick. So now they feel like we need to step in and stabilize this, but they're running the other way from fiscal. So that's where, as Becky said, they're going to do one thing for a month and then come back. Once we have that set, we're going to go back to where we were. Hard to do.
I guess the question would be, what are the market implications? What would you do as an investor when you're looking at these global markets? Which do you believe and which do you not in terms of the snapback potential?
Well, part of that, Becky, is reflected in the dollar. Yeah. What investors say is, wait a minute, the Fed is quite clear in the U.S. Yeah. Now, part of the strong dollar attracts capital, but still, we're consistent with where we're going here. The Fed is now, and Powell he's not hedging his language anymore. I mean, we've gone from being very careful, soft landing, to there's going to be pain, and if there is pain, we're going to have to experience it to get this back on track. So the dollar continues to strengthen because around the world, people look at the U.S. and say this is the best bet that's out there from a macroeconomic standpoint.
Think if the Fed were to just give us the slightest bit of a blink, or just the possibility that they're data dependent and they see mortgage rates and they understand that a hard landing isn't something that we're all really looking forward to, would that be bad for the markets?
I think he should stay with where he is now, Joe.
You do?
And I do. And I actually think that he's getting what he wants. I mean, look at the markets that have cracked. I mean, from SPACs gone to, crypto's had a lot taken out of it. Equities are struggling now. He wants some of this because it's pulling demand out and it's doing part of what he needs done. I think you're not going to see. I think now that they've gotten to where they are in the 3% range, I think it's unlikely they continue with 75 basis points. They probably start to pare it back a little, maybe 50. But I do think he's going to keep going. I think the rhetoric will keep going, and I think that he gets to 4.5%, 5%. We did an analysis at Rockefeller that looked at the last 50 years Fed tightening cycles. And since 1970, every time the Fed started to raise rates, they didn't stop until the Fed funds rate was higher than CPI. So we've got 8.2, 8.3, and 3-ish% now.
4.5%, 5% is higher than a lot of people are anticipating.
But you probably have to get there.
Let's use core.
Well, but the analysis is CPI.
Yeah. So weak.
So Joe, it's probably 4.5, 5, Becky, where you're saying.
We can't do CPI, Fleming. Do the core.
I'm just telling you what history says.
Don't say that.
History says that they're going to have to keep going to the lines crossed. I would love it if the lines crossed earlier.
Yeah.
But it doesn't look like that's going to happen at this point.
Does that get you to the Jason Furman analysis of thinking 6.5% unemployment for 2 years?
That'd be worse.
That seems high to me. But I mean, Jason was the one who surprisingly stepped in on the fiscal side and said, on the student loan, it was like pouring gasoline on the fire, which is similar to what we're dealing with in the UK. Right.